You open your laptop, do some quick math, and it looks almost too easy. Buy a fleet of cars, rent them out at $60 a day. Cover the loan payment, cover insurance, pocket the rest. 100 cars, rented most days of the year, and you're running what looks like a straightforward, almost boring cash machine. That's the appealing version. It's also almost completely wrong. A car rental company doesn't really make its money renting cars. It makes its money, or loses it, buying and selling them. The daily rental fee you pay at the counter is closer to a service charge layered on top of the real business happening underneath. A constant, high-stakes cycle of purchasing vehicles, running them for a matter of months, and then getting rid of them before they lose too much value. Understanding that one shift in perspective changes everything about how this industry actually works, why it periodically implodes, and why a company can look wildly profitable one year and be begging for a bailout the next. To see why, you have to look at where the money actually goes. Fuel is a real cost. Labor, insurance, and airport concession fees are real costs, but none of them come close to the single largest line item on a rental company's books: depreciation. A car bought for $28,000 and sold 18 months later for $19,000 has cost the company $9,000, often more than the fuel, cleaning, and maintenance on that vehicle combined. Every single car in the fleet is a depreciating asset on a clock, and the entire business exists to manage that clock profitably. Rent it out enough, at a high enough price, before you have to sell it, and hope you can sell it for more than you feared. That single fact reframes the whole industry. A rental company isn't primarily competing on service or convenience, even though that's the layer customers experience. It's competing on its ability to predict and control the resale value of hundreds of thousands of vehicles years before it has to sell them. Get that forecast right, and margins look healthy. Get it wrong, and the used car market has a habit of moving without warning, and a company can lose more money in a single fleet cycle than it earned from years of rentals.
For decades, the industry found a clever way to step this risk entirely, and most customers never had any idea it existed. It's called a manufacturer repurchase program, and it used to be the backbone of the business. Under this arrangement, an automaker would sell vehicles to a rental company at a set price, on the condition that the automaker would buy them back later at a guaranteed price, minus a small predetermined depreciation charge. This is often called risk fleet versus non-risk fleet internally. Non-risk cars, the ones covered by a buyback deal, carry no exposure to the used car market at all. The manufacturer absorbs it. Risk fleet, the cars without that safety net, expose the rental company directly to however the resale market happens to be moving on the day they sell. Automakers liked these programs because they guaranteed enormous bulk orders, which kept assembly lines running at full capacity regardless of retail demand. Rental companies liked them because they converted an unpredictable financial risk into a fixed, budgetable cost, closer to a subscription than a bet. For years, this arrangement quietly insulated an entire industry from its biggest structural danger.
But that insulation faded. As automakers shifted toward leaner production models and stopped needing guaranteed rental fleet volume to fill factories, buyback programs shrank, and companies leaned more heavily on risk fleet, cars they'd have to sell into the open used car market themselves, at whatever price that market happened to offer. That single shift didn't attract headlines. It quietly turned rental car companies into something closer to hedge funds for used sedans, fully exposed to price swings they don't control. Once you understand that exposure, the second hidden variable comes into focus: utilization. This is the percentage of days a car in the fleet is actually out being rented versus sitting idle in a lot. It sounds like a minor operational detail. It's closer to the industry's real scoreboard. A company can have a packed, gleaming lot of vehicles and still be in serious trouble because every unrented car is still depreciating, still accruing insurance and storage costs, and still tying up capital that produced no revenue that day. A lot that looks impressively full to a passerby can, to the finance team, look like a warehouse of daily losses.
This is why rental companies obsess over shaving fleet size down to the minimum needed to demand, and why they scramble to sell excess cars fast when demand drops.
Too few cars, and you turn away paying customers and lose revenue you'll never recover. Too many cars, and depreciation quietly eats you alive while the lot looks perfectly healthy from the outside. Getting that balance right, continuously, across thousands of vehicles and dozens of cities, is arguably harder than anything happening at the rental counter. There's a third layer most customers walk right past without noticing, and it's worth pausing on because it flips a common assumption. You'd assume the rental fee is the main event, and everything else, the insurance offer, the prepay and save fuel option, the size upgrade pitch, is a minor add-on. Financially, it's often closer to the reverse. These ancillary products tend to carry far higher margins than the base rental rate because the company doesn't have to buy, insure, or depreciate an extra asset to sell them. An employee mentioning a $15 a day damage waiver or nudging a customer into a slightly bigger car for a few extra dollars can add more pure profit per transaction than the underlying rental itself. The car gets you in the door. The add-ons are frequently where a meaningful share of the actual margin lives.
Put those three pieces together: depreciation as the dominant cost, utilization as the real health metric, and ancillary sales as an outsized profit source, and you have the skeleton of how this industry actually functions. Now watch what happens when all three collide at once, because that's exactly what played out over a few remarkable years starting in 2020. When travel collapsed in the spring of that year, rental demand didn't just dip, it fell off a cliff almost overnight. Suddenly, companies were sitting on enormous fleets of cars nobody was renting, each one still depreciating, still costing money to insure and store, with utilization cratering toward levels the industry had never planned for. The response was rational but drastic. Sell off huge portions of the fleet, fast, to stop the bleeding. Rental companies became some of the largest sellers into the used car market almost overnight.
That decision, made under emergency conditions, set up the next domino. Around the same time, a global semiconductor shortage was choking new vehicle production, meaning automakers couldn't build replacement cars nearly as fast as usual. So when travel demand roared back far sooner than almost anyone expected, rental companies found themselves in a position they'd never really faced before. Strong demand, but a fleet they had just gutted, and no fast way to refill it, because new cars simply weren't available in normal volumes.
The result was a supply squeeze layered directly onto a demand surge, and prices responded exactly the way you'd expect scarcity to make them respond. Daily rental rates in some U.S. markets more than doubled compared to pre-pandemic norms through 2021 and into 2022. Renting an ordinary sedan for what used to cost $40 a day suddenly cost $100 or more in many cities, occasionally spiking dramatically higher around holidays or major events when supply was tightest. For an industry that had spent years grinding out thin margins, this was a windfall. Depreciation costs, meanwhile, were also unusually favorable, because with new cars scarce, used car values were simultaneously rising, meaning the very risk-fleet vehicles that used to be a source of anxiety were, for a stretch, appreciating rather than depreciating on the books. Companies were effectively getting paid twice, once from soaring rental rates, and again from selling cars for more than they'd paid. It looked, briefly, like the entire industry had discovered a new, permanently better version of itself. That impression turned out to be the setup for the next chapter, not the ending. To see how the story actually unfolded, it helps to follow one company closely, because it captures almost every mechanic in this industry in a single, well-documented arc: Hertz.
Hertz entered 2020 as one of the largest rental companies in the world, and within months filed for Chapter 11 bankruptcy, overwhelmed by debt and a fleet it suddenly couldn't fill or finance under collapsed demand. That looked, at the time, like a fairly conventional story of an old, debt-heavy company finally buckling under a crisis. But the recovery that followed was almost the opposite of conventional. Emerging from bankruptcy in mid-2021 under new ownership, Hertz rode the exact rate surge and used car appreciation described above, and the results were startling. The company swung to sizable profits, and its newly issued stock became a popular trading story, even attracting attention from retail investors who'd watched it go from bankrupt to booming in under a year. Riding that momentum, Hertz made a bold, headline-grabbing bet in late 2021,
and order for 100,000 Tesla vehicles, positioning itself as an early, aggressive mover into electric rental fleets, with plans to expand its EV lineup further with other automakers afterward. On paper, this fit the moment. EVs were in high demand, Tesla stock was soaring, and offering electric rentals promised a premium, headline-friendly product that could set Hertz apart. The first warning signs showed up quietly, in the operational details rental customers don't usually think about. EVs require different infrastructure, charging logistics at rental locations, staff trained on handling and explaining unfamiliar vehicles, and, critically, materially higher repair costs when accidents happened, since EV collision repair and specialized parts tended to run more expensive than for comparable gas vehicles. None of that alone was fatal, but it started chipping away at the economics of the EV portion of the fleet in ways that weren't obvious from the outside. The real turning point came from the same variable that governs this entire industry: resale value. As EV demand cooled relative to earlier expectations, and as price cuts from manufacturers like Tesla rippled through the broader new and used electric vehicle market, the resale value of Hertz's EV fleet fell faster and further than the company had planned for. Suddenly, a huge portion of its risk fleet, the cars with no manufacturer buyback safety net, was depreciating at a painful rate, precisely the scenario that repurchase programs used to exist to prevent.
The consequences accelerated from there. Through 2023 and into 2024, Hertz began walking the EV strategy back substantially, announcing plans to sell off a large portion of its electric fleet, on the order of 20,000 vehicles, while shifting future purchasing back toward traditional gas and hybrid vehicles. The company disclosed billions of dollars in charges tied largely to EV depreciation and the associated fleet write-downs. Its CEO departed, and the stock that had once been a celebrated bankruptcy to boom story fell sharply from its post-recovery highs. What makes Hertz such a clean case study isn't that the company made an unusually reckless decision. It's that every mechanic discussed earlier in this video shows up explicitly in its numbers: the dominance of depreciation as a cost, the danger of risk fleet without a buyback cushion, the way a strong-looking headline order can mask a resale value problem building underneath it, and the way one mistimed bet on future value can outweigh years of otherwise solid operating performance. Hertz didn't fail because people stopped renting cars from it. It struggled because it misjudged what a large chunk of its fleet would be worth when it eventually had to sell it, the exact same risk that has always sat quietly underneath this entire industry.
The broader industry took notes. In the years since, rental companies have generally moved toward more cautious EV adoption, expanding hybrid offerings instead, where fuel savings appeal to customers without the same resale volatility currently seen in the EV segment. Fleet cycles have gotten tighter and more data-driven, with companies using more sophisticated forecasting to match fleet size to real-time demand, rather than relying on rough seasonal estimates. Dynamic pricing, already common by the early 2020s, has become even more aggressive and granular, adjusting rates by the hour based on local supply, weather, and event calendars. And ancillary revenue, insurance products, fuel options, loyalty programs, has become an even more deliberate focus, precisely because it's less exposed to the used car market's mood swings than the core fleet itself. So what does ownership in this industry actually look like today, stripped of both the pandemic-era windfall story and the EV cautionary tale?
In the best case, an owner runs a tightly forecasted fleet, keeps utilization high, times vehicle purchases and sales around favorable points in the used car cycle, and layers in strong ancillary revenue, producing steady, genuinely attractive margins, the kind that made Hertz's brief 2021 window look so appealing. In the realistic successful case, margins are thinner and more cyclical than that, with a few very good years offsetting a few mediocre ones, and real profitability depending heavily on disciplined fleet management rather than rental volume alone. In the realistic negative case, a company misjudges depreciation or overextends into an unproven vehicle category, and a single fleet cycle wipes out several years of otherwise solid operating profit. And in the outright failure case, which is essentially the 2020 Hertz story, a demand shock and a debt-heavy balance sheet combine, and there simply isn't enough cash flow left to service the loans on a fleet nobody's renting.
So go back to that opening picture. Buy cars, rent them out, pocket the spread. It's not wrong, exactly. It's just describing the smallest, least risky part of a much bigger operation. The real business is forecasting what a car will be worth long after you've stopped needing anyone to drive it, financing an enormous, constantly depreciating asset base against that forecast, and hoping the used car market cooperates with your timeline. Renting the car is simply how the company earns money while it waits to find out if that bet was right. That's what a car rental company really is underneath the counter transaction and the loyalty app. A leveraged wager on the future price of a fleet of used cars, wearing the costume of a service business.